We have talked about consolidation entries for intra-entity net transfer. Now let's look at intra-entity depreciable asset transfer. So there are three consolidation entries for intra-entity depreciable asset transfer: consolidation entry TA, consolidation entry ED, consolidation entry star TA. So in general, in the year of transfer, we need to, on the consolidation worksheet, we need to make consolidation entry TA and consolidation entry ED. And in all of the subsequent years, we need to make consolidation entry star TA. The purpose of star TA is basically to carry over the effect of TA and ED in the previous year. And in addition, we need to make ED entry again. And then 1 year later, so your star TA and ED becomes your new star TA entry. And we need to make another ED again. So, and then this goes on and on. So every year, in other words, every year following the year of transfer, we need to make consolidation entry star TA and ED. The accounts we record for star TA entry are the same each of the following year, but the numbers we record for those accounts will be different. And I'm going to talk about more specifically later when we go through the example. So first, let's look at the TA entry. The purpose of TA entry is to eliminate the effect of intra-entity transfer of depreciable asset. And specifically, the entry looks like this. We debit gain on sale of equipment, debit equipment, credit accumulative depreciation. Or in other words, this entry is just to defer the gain from transfer of the intra-entity depreciable asset, because that depreciable asset it's not a transfer with any outside party. So if there's any gain, it can also be a loss, actually. If it is a loss, we need to credit a loss on sale of equipment. But the idea is any gain or loss we generate from those intra-entity transfer needs to be credit, either debit or credit back. And consolidation entry ED, the purpose is to eliminate excess depreciation caused by inflated transfer price. So here the assumption is the transfer make the asset appreciate in value. And then the journal entry is to debit accumulative depreciation, credit depreciation expense. Or in other words, we just need to reverse that part of, because if the transfer make the asset appreciate in value, then the new depreciation will be based on appreciated value. So we would be recording more depreciation, which shouldn't be if we view two firms as one firm. So we need to credit that depreciation expense back, because when we record depreciation expense, it is at the debit side. So we need to, in order to lower the depreciation expense, we need to credit it back. So this actually, the assumption here is the transfer make the asset, the depreciable asset, appreciate in value. But in some situations, the transfer may be at a lower price. It may make the asset decrease in value. In that situation, we just need to reverse these two sides of the journal entry. So in the situation, the transfer make the asset depreciate in value, the entry would be to debit depreciation expense, credit accumulative depreciation. Consolidation entry star TA, so star here just refers to this entry is to take care of the transaction which happened in the previous year. So return the equipment account to original historic cost, correct the beginning of the year balance of retained earning and accumulative depreciation. So basically, the entry is to debit retained earning at the beginning of the year for the seller, debit equipment account, credit accumulative depreciation. And then if it is downstream, the parent use the equity method, we need to debit investment account instead of debit retained earning. And then debit retained earning for the seller, debit equipment account, and credit accumulative depreciation. If it is downstream, the seller is the parent. If it is upstream, the seller is the subsidiary. And then if it is downstream, the parent used the equity method with debit investment account instead. So here, let's look at an example. Now, Able is the parent. Able purchased the equipment for 100,000 several years ago and has recorded 40,000 depreciation. So the book value now is 60,000. And Able sold the equipment to Baker. Baker is Able's subsidiary. The equipment is sold for 90,000 in 2017. And then the equipment has a remaining useful life of 10 years. So as you can see here, the equipment, when it is recorded on Able's book, each year the depreciation expense is 6,000. So that's 60,000 divided by 10 years. After it is moved to Baker's book, the depreciation expense becomes 9,000, which is 90,000 divided by 10 years. So by selling this equipment, the depreciation expense, not only is this equipment appreciated 30,000 in value, but also the depreciation each year is 3,000 more. Should Able use the initial value method, what are the consolidation entries in year 2017 and the years afterward? So here I just want you to write out year 2017, year 2018, and year 2019. And for the following years, we can it will be just the same as what we are doing here. So please take 15 minutes. Try to work on this example. You can pause your video for now. So let's look at how to work out those consolidation entries. Year 2017 is the year of transfer. Able is the parent. Baker is the subsidiary, and those two firms should be viewed as one firm. So on Able's book, Able sold the equipment to Baker for 90,000. And then that equipment, so when Able has sold the equipment, it can write off the equipment from its book. On its book, the equipment is recorded. The face value of the equipment is 100,000, so which can be written off now. The accumulative depreciation is 40,000. That can also be written off because accumulative depreciation is recorded at the credit side. So to write it off, we debit accumulative depreciation for 40,000. And then this journal entry doesn't balance. Why it doesn't balance? Because Able is selling the equipment equipment which has 60,000 book value at 90,000. So Able is actually making 30,000 gain from selling of this equipment. So we need to record the gain on sale of equipment for 30,000. So now this journal entry balance. So this is Able's journal entry. And for Baker, Baker just simply purchased an equipment. So it paid out 90,000 cash and purchased equipment. And then it is recording this equipment as the cost of the equipment, which is 90,000. So this is Baker's journal entry. And if you look at two firms as one firm, the firm hasn't sold any equipment to any other third party. It's just transfer an equipment from its left hand to its right hand. So it just sending to itself. So nothing should be recognized if you view two firms as one firm. So what should we do here? We have Abel and Baker, and we need to make it as if nothing happened. As you can see here, Abel, even though Baker paid out 90,000 cash, it is received by Abel. So cash doesn't change at all if you view two firms as one firm. So cash is correct here. And then equipment. So the original cost of the equipment is 100, and Abel, when it sold the equipment, it is written off 100,000 cost. But when Baker received the equipment, it is recording it as at 90,000. So here, the equipment, it is undervalued by 10,000 here. To mark it up, we debit 10,000 for equipment. Accumulative depreciation. Accumulative depreciation is decreased by 40,000 by Abel, and Baker hasn't begun recording any accumulative depreciation yet. And this 40,000 written off of accumulative depreciation shouldn't happen. So we need to credit accumulative depreciation 40,000. And then lastly, gain on sale of equipment. If you view two firms as one firm, there shouldn't be any gain. So we need to write this off by debit 30,000 gain on sale of equipment. And this general entry, which is to debit equipment 10,000, debit gain on sale of equipment for 30,000, and credit accumulative depreciation for 40,000. This entry is called TA entry. So this is the first entry we need to make in the year 2017. And then there's a second entry we need to make in the year 2017. So from Abel's side, we again have Abel, Baker, and Abel plus Baker. On Abel's side, if the machine is still, if Abel hasn't, so on Abel's side, because Abel has sold the machine, so does Abel need to record any depreciation for the year? No, right? So Abel no longer have the machine. So in the year 2017, Abel doesn't need to record depreciation. However, for Baker, Baker now has a machine, and the machine is valued at face value of 90,000. So each year, the depreciation Baker needs to record is 90,000 divided by 10 years. So that's 9,000 per year. So for Baker, it needs to record depreciation expense for 9,000 and credit accumulative depreciation for 9,000 at the end of the year. And if you view Abel and Baker as one firm, so this machine, suppose it hasn't changed hand yet, so it is still depreciating based on 60,000 over 10 years. So each year, 6,000 per year. Depreciation. So each year, the depreciation should be 6,000. Depreciation expense should be 6,000, and we credit accumulative depreciation for 6,000. And as you can see here, that because of the sale of this equipment, the depreciation expense is overstated by 3,000, and we need to mark it down by 3,000. And the cumulative depreciation is overstated by 3,000. We need to mark it down as well by 3,000 by debited. And this entry is our ED entry. So this is what we do in the year 2017. And this is what we do in the year 2017. And then let's move 1 year forward. In the year 2018, what should we do? Which is 1 year after the year of the transfer. So in 2018, the first thing we should do is to carry over. In 2017, we have TA entry, which is basically debit equipment, 10,000, debit gain on sale of equipment for 30,000, and credit accumulative depreciation for 40,000. And then we have the ED entry, which is to debit accumulative depreciation for 3,000 and credit depreciation expense for 3,000. So those are the two general entries we make in the year 2017. And in the year, sorry, I will need to write it again. So those are the two entries we make in the year 2017. And in the year 2018, the first thing we need to do is we need to carry over the effect of these two general entries to the year 2018. And because all of the income statement accounts has been closed into retained earnings, so when we carry it forward to the year 2018, we need to replace all of the income statement account with retained earnings. So basically, gain here can be replaced with retained earnings. Depreciation expense can be replaced with retained earnings, and everything else is the same. So if we combine those two general entries, that will give us debit equipment for 10,000, debit retained earnings for able at the beginning of the year 2018. So let me just write it here. Because this is a downstream sale, so we are just a beginning retained earning for the parent. And then 30,000 minus 3,000, so that's 27,000. And we credit accumulative depreciation 40,000 minus 3,000. So that's 30. Oh, sorry. 37,000. So this entry is our star TA entry in the year 2018. And then another entry we need to make in the year 2018 is, because in the year 2018, that, so let me just write it over here again. So this is the first entry. And then the second entry is, we have able baker and able plus baker, right? So in the year 2018, the same depreciation problem happened again. So it's the same thing as what is happening in the previous year. Because Baker still, the asset is still on Baker's book. So each year, Baker is making depreciation at 9,000 per year. But if you view two firms as one firm, the depreciation should always be 6,000 per year. So for every year afterwards, we need to adjust that 3,000 difference in depreciation expense every year. So on Baker's book, Baker would record depreciation expense for 9,000 and accumulative depreciation for 9,000. If you view two firms as one firm, the depreciation should be 6,000 and accumulative depreciation should be 6,000. So to adjust it back, we need to decrease depreciation expense by 3,000 and decrease accumulative depreciation by 3,000. And this entry is the ED entry in the year 2018. So even though this entry looks the same as the one we make in the year 2017, it's just we need to repeat this entry every year. Even though it looks the same, but it is another entry. So this is what we do in the year 2018. So we have talked about the year 2017 and 2018. Now let's look at what will happen in the year 2019. So I'm just going to talk about 3 years here, but it can just go on for the rest of the 10 years. So it's just we're repeating the same thing again and again. Here for illustration purpose, I'm just going to cover 3 years. So in the year 2019, first of all, we need to do the same thing again. We need to have the start TA entry and how we figure out that entry. So let's start from in the year 2018. We have a start TA entry, which is to debit equipment. And we're debiting retained earning for able. So this is 10,000 and 27,000. And we credit accumulative depreciation, 37,000. So this is start year entry in the year 2018. In the year 2018, we also have the ED entry, which is to debit accumulative depreciation for 3,000 and credit depreciation expense for 3,000. So those are the 2 entries in the year 2018. And in year 2019, the first thing we need to do is to carry over the effect of these 2 journal entries. So we know that depreciation expense is going to be close into retained earnings, so we can replace it with retained earning. So we have debit equipment for 10,000 and credit retained earning 27 minus 3,000. So that is retained earning for able at the beginning of the year for 24,000. And then accumulative depreciation is 37 minus 3, so that's 34. So we credit accumulative depreciation for 34,000. So this is the entry start TA in the year 2019. And then we just do the same thing again. So this is the first entry, and the second entry is the ED entry in the year 2019, which is basically the same as before. We debit accumulative depreciation for 3,000 and credit depreciation expense for 3,000. So those are the 2 entries in the year 2019. And if you want to move forward to the year 2020, we just do the same thing again. So those are the general entries. And then what if the transaction is downstream and able uses the equity method? In this situation, almost everything is the same as before. The only difference is instead of debit retained earning, we debit investment. Investment in the investment account instead. So that is the only difference. And this is all for the transfer of intra-entity transfer of depreciable asset.